Welcome back. We just studied capital structure in a world with corporate income taxes. You learned that companies prefer to call payouts interests rather than dividends because this allows them to tax deduct the payment, effectively because they can pay interest from pre-tax income rather than post-tax income. But corporate income taxes are not the only tax we have to consider. There are also personal income taxes. It turns out that they are somewhat of a counterweight because retail investors prefer the payouts to be called dividends or capital gains. Interest payments suffer the worst personal income tax consequences of all forms of income. However, there is a twist. There are different types of firms and different types of investors, and they sort of collude to quote unquote cheat the IRS of tax revenue. Let's go over this. We now add personal income taxes to the economy. Now, before we were talking about the form of financing if debt is preference, that is, the payments to creditors but not for shareholders can be deducted from profits. Now we're going to add a second issue in here. We're going to have the shareholders pay lower taxes than creditors on their receipts. And if that is the case, if debt and equity are not treated symmetrically but on both sides, rather than just before as debt with a firm side, what should be the outcome?
Please pause this video now, answer the question on a piece of paper, and then continue.
It's no longer clear. If you pay too much in interest, it is great for the company, but it could be terrible for the investors if they have a very high tax burden. So let's recap for a moment the capital gains taxes. We know that capital gains taxes are effectively taxed at lower rates. There's a lower statutory tax rate on capital gains. They occur only on realization, if ever. They can be offset with capital losses. They can be moved to foreign locales. And most importantly, for a lot of investors, they are stepped up. Their basis is stepped up for free at death. So if you inherit something like $10 million and your father, mother have bought this at $1 million, usually you would owe $9 million in capital gains taxes on that realized. But it turns out that the step up on death means that you don't pay the taxes because the first 9 millions are exempt. And at that point, you get the step up and your new basis is $10 million. Now, the US also has a 50% tax rate on estate taxes. So we oscillate between insanely high tax rates above the $15 million or whatever it is at the moment, 50%, that's crazy, and insanely low inheritance taxes. That means they have only zero, that you pay no taxes whatsoever. Not surprisingly, for the insanely high taxes, there's a huge tax evasion industry. These also tend to be very wealthy people. Now, interest receipts are always taxed at ordinary W-2 income tax rates, which tend to be 40 to 50%, and they cannot be sheltered. So, unless interest receipts are from tax-exempt munis, municipal bonds, state bonds, which corporations cannot issue, you really don't like to receive interest receipts as an investor. So, we're going to try and bring in the personal income tax effect. Intuitively, what will be the effect of personal income taxes on tilting the optimal capital structure, aggregate preferences on corporate tax debt versus corporate equity? If we have personal income taxes, which direction should it go towards? Should it favor debt or should it favor equity?
Please pause this video now, answer the question on a piece of paper, and then continue.
On the simplest level, it makes equity relatively more desirable than debt, at least for taxed personal investors, because the capital gains taxes are lower than the interest taxes, because they can be delayed and because capital losses can be used to offset them too. I like to think in terms of extreme example. What if, for example, you knew that interest was taxed at 100%? Well, under those circumstances, you know that it would be terrible if companies had debt that had to pay out interest, because nothing would be left to their investors. On a more complex level, it depends on which investors are taxable and which are not, and what they are holding. In the real economy, there are two types of investors. One is very low tax or tax exempt. So, for example, endowments or pension funds pay no taxes whatsoever. So, for them, getting interest receipts doesn't matter. They can just hold them, they don't have to pay anything. Then there are the you and me, our retail brokerage account, rather than our pension fund 401k account, which tends to be tax preferred. We have to pay the full taxes on interest. There's also a strict pecking order. So if you have both a retail account and a 401k account, the fixed income receipts should be preferentially held by your 401k rather than by your retail account. Now, let's presume we are a family and we rule the economy, except for Uncle Sam. Uncle Sam is not good for us. The less Uncle Sam gets, the more we get, our family gets. The more Uncle Sam takes, the less we get. Point is, what can we do to pay out less to Uncle Sam? Now, we're going to assume an economy that consists of two firms. One is a high-tax firm. Let's call it a cash cow. Think of this firm as cash cow, low growth, producing tons of profit, old firm, with a tax rate of 30%. The other firm is a firm that's a growth firm. It hasn't made any profits yet. So that means it doesn't have a very high tax rate. Very fast growing firm, very young firm, large net operating losses, perhaps from last year. And let's assume that we in the economy need to fund both. Let's also assume that our family economy consists of two types of investors. One is this retail investor with a brokerage account, taxed at the highest personal income tax rate, 40%. The other is an endowment or pension plan or retirement vehicle, not taxed. And both need to invest their funds. And I'm going to assume the following now. For the taxed investors, the corporate income tax is 30%, the personal income tax is 40%, and the capital gains tax is effectively 10%. Those numbers are not far off from real life. For either type of firms, I want you to think about choosing the method of payment, and that can be capital gains, retained earnings, or interest payments. And for either type of investor, I want you to determine what you would preferably want to hold. Debt, which would pay interest, or equity, which basically would mean that you're only subject to capital gains taxes rather than to interest taxes. So we're going to play the equivalent of SimCity, or if you want to think about an old sci-fi horror master, Heinlein's Puppet Masters. Think about who should own what and who should issue what. Now, you cannot assume that the economy is all growth firms held by tax-exempt investors. There are taxable investors that also need to invest their money, and there are cash cow firms that also has to raise funding. So you have to allocate both types of firms and both types of investors. So this is how the economy could look like. We're going to have cash cow firms. We're going to have growth firms. We're going to presume the firm starts with $100 in money, and it can figure out what to do with it. So take a look at the first item here, for example. we've got $100 that the firm has earned. Now, if it issues debt, it can pay the money, the entire money from pre-tax earnings. There is no corporate income tax collected on those $100. Now, the money as debt comes in terms of interest to your retail investors in this particular box. That means the investors, the retail investors, have to pay 40% tax on the interest receipts. Uncle Sam gets 40, the retail investors get 60. That's only half the economy. We also have to think about what growth firms should do. Now, the growth firms, let's presume they also earned just $100. Well, they haven't made any money yet, so it's still $100, and they're being held by the tax-exempt investors. And the tax-exempt investors also don't pay tax, so Uncle Sam gets nothing from this particular box. In sum, there's $40 that go to Uncle Sam. Now, let's look at our next box. We again have our cash cow firm, and it has earned $100. Unfortunately, this cannot be paid out from pre-tax earnings. The firm first has to pay corporate income taxes on this. And because we've assumed that corporate income taxes are 30%, there's only $70 that can be paid out. The $70 are going to go to retail investors. And because they go in capital gains, they have a much lower tax rate, a much lower personal income tax rate. We've assumed that to be 10%. So that would be $63 here. Now, if we did that, then for the growth firms, they would have to finance themselves with debt. The nonprofit investors would get 100, but of course they never have to pay any taxes. So we get $37 in total in the economy to go to Uncle Sam. Let's try another one. Let's presume the cash cow firm makes $100 and it's going to pay that out in debt. So after corporate income taxes, it's still $100 because it's paid from pre-tax income. And now it's being held by tax-exempt investors. So the tax-exempt investors don't pay any taxes, so they get the whole $100. What about the growth firms? Well, if they issue equity, then they still don't have to pay any corporate income tax because they are growth firms. They haven't made any money yet. They have net operating losses. They just don't need to pay anything yet. So there's $100 left that the firm can still pay out. The retail investors get the money in capital gains, which means that at the end of the day, they only pay 10% taxes. For $100, that means they keep $90. In this case, we have a scenario in which Uncle Sam gets $10. Let's look at the final box. Again, we have the cash cow firm. Again, it earns $100. Well, since it wants to pay out in equity at this point, after corporate income tax, there's only $70 to be paid out. It's being held now by tax exempt, so they get to keep the whole $70. What are we going to do with debt? Well, the growth firm now is going to pay in debt, but it's actually wasted money in some sense because there is no use to the tax shelter here. The growth firm doesn't have any positive earnings to take that down on. So they've made $100 in debt and they still can pay out $100 in debt. That now comes as interest payment to retail investors as $60. So in total, $40 tax plus $30 tax is $70. Now look at the four possibilities that there are. It is clear that the third possibility just dominates. Debt should be preferentially held by tax-exempt institutions and should be preferentially paid by cash cow companies. Equity should be primarily issued by growth firms, and that should be held primarily by retail investors. Under those arrangements, Uncle Sam gets the least money. There is no puppet master. How could such holding coincidences ever happen in the real world?
Please pause this video now, answer the question on a piece of paper, and then continue.
Prices. So here's an example worked out for you. We're going to assume risk neutrality. We're going to say the expected rate of return were 10% on taxable corporate interest and 8% on capital gains. So all that we need to show is that that would lead our tax-exempt institutions to prefer the taxable corporate interest payment and would prefer our retail investors to prefer the capital gains, and that the cash cows under those circumstances would rather issue debt and the growth firms would rather issue equity. So taxable investors, retail investors, prefer the 8% capital gains from growth firms. The tax-exempt investors prefer the 10% rate of return from cash cows. The cash cows prefer to pay 10% for debt because their effective cost is 10% times 1 minus their tax rate, 7%. So for them, the debt is cheaper than the equity. The growth firms prefer to pay the 8% for equity. For them, that is cheaper than the 10%. Now, this example has abstracted away from discounts and premia, risk premia, diversification, if you have an entrepreneur who is not public, but the example does indeed generalize. Capital markets are very good at moving resources to their best uses. Here, best simply means cutting out Uncle Sam. The model is not complete. There are also non-tax considerations here, which we have skipped, which we will talk about in the next few videos. But by and large, it's pretty accurate. Retail investors tend to be comparatively more invested in the stock market and comparably more in companies that don't have very high corporate income tax rates. And institutions and endowments are relatively more invested in the bond markets. By analogy, what do you think would calibrate the movement of tax-exempt investors towards treasury bonds and taxable retail investors towards municipal bonds? Remember, municipal bonds pay tax-exempt money to their investors.
Please pause this video now, answer the question on a piece of paper, and then continue.
Actually, we already had this. We talked about pre-tax versus after-tax returns. Recall chapter 11, our third video. Now, almost done. Write down the weighted average cost of capital formula with corporate income taxes from memory. This is one of the few formulas that you should remember.
Please pause this video now, answer the question on a piece of paper, and then continue.
That was on the previous slide. The weighted average cost of capital is the weight invested in equity times the cost of capital on equity, plus the weight invested in debt times the cost of capital on debt, multiplied by 1 minus tau, the tax rate. How do you, as a corporate manager doing capital budgeting, adjust the weighted average cost of capital, for that matter, the APV formula, not only for your own corporate income taxes, but also for your investors' personal income taxes?
Please pause this video now, answer the question on a piece of paper, and then continue.
You don't. You can just use the same WACC formula. Any advantages or disadvantages that your investors care about is embedded in the required rate of return, in the cost of capital that these capital providers are quoting you. So it sits in the ERE and in the ER debt. That's it for this video, for chapter 18, and for the influence of income taxes on core capital structure. In the next chapter, we look at the logic underlying capital structure decisions when there are considerations other than taxes too. So, See you soon. Bis bald.
Hello, is this Father O'Malley?
It is?
This is the RAS. We need to check something with you.
Sure thing.
Is Ted Houlihan your parishioner?
Yes, he is.
We wanted to check. Did he donate 100,000 to your church?
He sure will now.